Tell us a little bit about your risk management process, both at the fund level as well as when doing underwriting on individual properties and notes.
Yeah, so we could go for a long time here about risk. I'll start with the first way we mitigate risk is, I heard this saying the other day. It's sort of relevant. Somebody said, am I doing things the right way, or am I doing the right things, right? And so it first starts off with we're investing in the right asset class in the right places that we believe are going to do well in recessionary and difficult times, right? So it first starts fundamentally with what we're invested in, and then it comes down to how we mitigate risk within that asset class. So first, I'll say I'm extremely active, as is our CFO, our head of development, our head of construction, our head of portfolio management, our head of management. All of our top leaders are all a part of an investment committee, all part of a credit committee that meets every single week and usually multiple times a week, evaluating opportunities. We have a large team of analysts and associates who are evaluating incoming opportunities using lots of different data sources, using lots of insights and perspective. Our own data we're cultivating through the thousands and thousands of opportunities we look at every day, doing full, thorough underwriting on local markets, on borrowers, on sponsors, on incoming supply, on new development, on construction, on rent growth, on employers, on all the various factors. Lots of components that go into it. That go into evaluating risk at an asset level, risk at a market level, risk at a strategy level, risk at a borrower or a sponsor level. So we've got a large team that does that. We fully document, build out very detailed underwriting, make very conservative assumptions to what's going to happen, which is where it often starts, right? Any deal can look like it makes sense in Excel if you just assume really great things are going to happen, right? If you just assume rents are going to go up 10% a year every year, deal probably looks pretty good, right? If you just assume that cap rates are going to stay at 4%, deal probably looks pretty good, right? But when you stress test what's going to happen if cap rates soften quite a bit. So we stress test what's going to happen in cap rates. We assume cap rates are going to be 150 to 200 basis points softer or higher than they are today when it comes time to sell. We assume, generally speaking, that rent growth is going to be between 2 to 3% annually in most of the markets we're in, even though last year, as I said earlier, it went up 19%. Right? We're going to assume that we're going to have 6, 7, 8% vacancy, and we're going to have bad debt. Not everybody's going to pay the rent, right? We're going to assume those things are going to happen, and even though our occupancies are actually higher than that, right? So we're real about what we're doing, and then the great value that allows us to be real about what's going on in the market and stress test things and be conservative is having great deal volume, right? When you have lots of options and lots of opportunities to invest in, it makes it a lot easier to make sure you're choosing the best opportunities. So we've got a large team of about 25 people in the front line out, bringing in developer and builder and sponsor relationships, bringing in direct deal opportunities. We've built a great reputation in the broker community. So we have heavy deal volume. We have somewhere between 1,000 to 2,000 deals, that come into us every month, and we close, 50, 60, 70 of them. So it takes a lot of effort, a lot of people, a lot of resources, right? I talk to other sponsors or syndicators, and they say, you have, 10 analysts looking at deals. I have one. Why do you have so many people? Well, because we're looking at a lot of stuff, right? Or people say, you have 25 full-time accountants, right? Why do you have 25 accountants? Right? I was talking to a sponsor almost our size and assets who has 1.5 accountants. We have 25. Well, it takes a lot of work to really run and manage the books well and manage the finances and make sure we're protecting ourselves, and we're seeing the trends and we're analyzing them and we're producing the analytics and we're producing variance reports and everything, right? This stuff takes people. It takes time. We're constantly working to use technology to help there in analytics, but it takes people. It takes effort. So those are some of the things we do. We can spend a lot more. I'm happy to dig down any path deeper on that, but those are some of the components to how we mitigate risk and how we evaluate risk.
The hosts of the YQA Investor Podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.